In this last video clip, we're going to look at the journal entries that the investor pass if the investor actually do prepare consolidated financial statements. Now, in the previous example, we looked at Bell Limited, assuming that Bell Limited does not prepare consolidated financial statements. And in that case, Bell Limited will pass the journal entries relating to his investment in the associate directly in his accounting records. But if he prepares consolidated financial statements, so there's a group structure where Bell Limited has a subsidiary, and therefore the group is required to prepare a set of consolidated financial statements, then your investment in associate will also be the entries that you pass will also be included on the consolidation worksheet, and it won't be passed in the investor's accounting records. This basically affects two areas of our equity accounting. First of all, because the journal entries in previous years relating to the investment in associate was not passed directly in the investor's accounting records, the effect of those transactions needs to be incorporated in the current year. The second area that's treated differently relates to dividends. Now, we had a look at dividends that are paid or declared by an associate and the treatment of it in the accounting records of the investor, where he does not prepare consolidated financial statements, and we saw there that no dividend revenue is recognized by the investor, and the dividend that is paid or declared is set off against the investment in the associate, because the share of the profit that we brought in our journal entry against that line item investment in associate was the profit figure before any distributions to the shareholders. However, when we look at dividend treatments in declared or paid by the associate, and there's a group structure where consolidated financial statements are prepared, the dividend revenue will be recognized in the investor account. So Bell Limited will record the dividend income or dividend revenue directly in his account, and then on consolidation that will be eliminated. But we'll have a look at those journal entries. So first of all, just put a calculation that we've already covered in the previous video clip, where we calculated Bell's share of the post-acquisition earnings of the associate, and we've calculated that as $49,800. We made an adjustment for depreciation relating to a depreciable asset that had to be revalued to fair value on acquisition date, and we reduce our share of the post-acquisition earnings by that figure, and that is then our share of the associate's profit or loss for the current year. We also saw then an increase in asset revaluation of $30,000, and our share in the higher equity figure was $9,000. So that we're also going to use this in this example. But because the journal entries aren't permanently made in the investor's account, we also need to consider what our share in the associate's profit and loss was for the period since acquisition date until the beginning of the current financial year, because that also needs to be adjusted in our consolidation worksheet. So just look at that calculation first. Okay, so this calculation covers the period since acquisition date until the beginning of the current financial year, and in this example it covers one financial year. We saw that the retained earnings balance at the end of the year, at the beginning of the current year, was $50,000, and when we made the acquisition, the retained earning balance was $10,000. So for the previous financial year, the retained earnings increased by $40,000, and that is our starting point for the profit after tax for the previous financial year. Adjustments that had to be made is that a general reserve was created in the previous financial year. It's an amount of $5,000 that was transferred to a general reserve. So we make the adjustment for the general reserve. And what we're doing is we're reversing the transfer to the general reserve, because we've already included the retained earnings figure, and the transfer was made from retained earnings. That last comment on the general reserve didn't quite make sense, so let's just try it again. When we made the acquisition on the 1st of July 2011, our general reserve balance was 0. So that is on the 1st of July 2011, and by the 30th of June 2012, the balance was $5,000 in the general reserve. So that means there's been an increase in the general reserve in the previous financial year, and therefore there's also an increase in post-acquisition equity of $5,000 relating to the financial period 2011-2012. In the previous example, we already calculated the realized profit that was lying in the opening inventory balance, so that would correspond with the unrealized profit at the end of the previous financial year. So we deduct the unrealized profit. In the current year, of course, in our calculation, we've included that as a realized profit. Okay, so our share of the associates' profit and loss at the end of the previous financial year is 30% of the $38,000, which is $11,400. To that, we have to adjust for the depreciation that relates to pre-acquisition equity and the revaluation of the depreciable asset on acquisition date of $630. Calculation of that we've also covered previously. So it gives us an amount of $10,770. And this relates to the next financial period. Okay, so let's use these two calculations, our share of the associates' profit and loss for the current year, as well as this calculation, our share for the previous financial year, to draw up our journals that needs to be passed.